All right. I know the lighting in here is not too good today, so I'm a little bit dark, so I apologize. Can't see my lovely face. Let's see if I can get that a little bit closer. It's a little bit better. Anyways, you guys know how I look like, right? So let me try. All right. Okay. So let me have just a few more seconds and then we will get started. Today we're going to be talking about tax laws, what's in place, what is being proposed, what I think about, strategies with regard to that on the estate planning side for strategies. There are some income tax strategies that I may touch on, but I'll leave that to your CPAs and other advisors to address. Okay, let's get started. So the agenda, let's make sense of the laws that have passed and the ones that are pending. And again, for those of you who don't know me, I'm Bobby Fazy, president of Insight Law. We do estate and business planning attorney. So I know we have some people who are guests that are in here. So we're going to recap the Consolidated Appropriations Act, which is law that was passed in December of last year. The American Rescue Plan Act, which was in March of this year. Talk about the enhanced child tax credit and overview and analysis of President Biden's tax plan. So the Consolidated Appropriations Act, CAA, first of all, it sent out a second round of economic stimulus checks, and that was authorized in December. $600 for singles, $1,200 if you're married filing jointly. But with most of the theme that's going on here, there are phase outs, okay? And you start phasing out if you're single and you make more than $75,000 of adjusted gross income. And if you're married filing jointly, that's the MFJ there. If you're married filing jointly and have 150,000 or more, you start phasing out. So all of these, the theme is you're going to start phasing out, and the other theme is there's kind of a line where, hey, the wealthy, we have this amount here that you're wealthy and that all these credits and tax benefits would not apply to you. All right, so charitable contributions. This is a good one, and that's in the CAA. So if you just take the standard deduction on your tax return, then what you can get again for this year is you can get above the line deduction. Above the line deductions are good for charitable contributions, $300 for singles, $600 for married filing jointly. So if you are making donations to charity, just make sure you relay that to your accountant. Those are above the line if you take the standard deduction. If you itemize, you get to utilize, usually you're limited, there's limits on your AGI and what you can deduct for charitable contributions if you itemize. This year, for cash, it's 100%, there's no AGI limitation. So a lot of high net worth people are taking advantage of that and making charitable gifts, they're kind of accelerating them because they don't have any phase outs. 60% limit is still in place for those contributions to what's called a donor advised fund, an easy way to contribute to charity. And then carryovers from prior years do not count towards that 100%. So you can't dip into the past years and use that over. But that's a good one if you are charitably inclined and are doing that anyway. Another big change to the CAA is that for 2021 and 2022, business owners, you can deduct 100% of meals for business purposes. Usually you're limited to 50%. Purpose of this is that the restaurant industry got hammered, right, with all of the COVID pandemic, and they're trying to get them kick-started again. And so that's a good one for business owners as far as the meals are now 100% deductible for this year and for next year. The medical expense deduction floor is now permanently set at 7.5%. If you have expenses over that, then you can make deductions. American Opportunity Tax Credit, these are for education, higher education for students and the like. And so you've got some phase outs with that as well. You get some credits for that. Third stimulus, so the American Rescue Plan ARPA, is that it authorized the third round of stimulus checks in March, and that was 1,400 for singles, up to 1,400, 2,800 for married filing jointly. But guess what? Phase outs occur still at 75,000 single, 150,000 married filing jointly. Individual provisions in the American Rescue Plan Act. First 10,200 of the unemployment benefits, if you filed for unemployment, not taxed if your adjusted gross income is less than 150K. The earned income tax credit expanded for low and moderate income taxpayers. So these are all for the lower wage earners, and during the COVID timeframe, you're not making a lot of that money and you're paying taxes on it. You get tax credits for that. But it stops, it phases out once you get to 400% of the federal poverty level. And the federal poverty level is pretty darn low. You can, it's around 20,000, a little bit less if you're single, and a little bit more the more people you have in your household. So, you know, you've got $80,000 there that they've expanded, and once you get over that amount, then that credit goes away. Child tax credits, they're trying to help on the child side. Again, these credits are great, they phase out. Okay, so if you're over these limits, so child tax credits, 2,000 per child, 3,000 per child, these, you know, these are great if you fall within these guidelines of 75K single, 150,000 married filing jointly. Head of household is 112.5 if you're filing that. That's kind of a unique way to file. Kids age 17 now qualify, and so again, the child tax credits are there. And then the child independent tax care credits, if you're using, you know, for care, daycare, and those types of things, they've expanded that, raised that for 8,000 for one child, 16,000 for two. Again, these are phased out. These phase outs are a little bit different. 50%, once you get to 125, it phases out completely over 400,000. You may get 20% if you're around 185,000. All right, so those are the laws that are in place. So those are the ones that have already passed, the CAA and the ARPA. Now the Biden's tax plan overview. This has not been passed. This is what they're arguing about, and we should know more around Labor Day, what the likelihood of which one of these provisions are going to pass. I can give you my thoughts on that, but there are significant changes, right, to individual and business taxes, and then those are contained in what's called the American Families Plan and the American Jobs Plan. The American Families Plan deals with individual taxes. American Jobs Plan deals with corporate taxes. So that you know the landscape, if you're not already aware of it, the Democrats narrowly control the House, 50-50 split between Democrats and Republicans in the Senate, but the Democrats hold the tiebreaker. Vice President can come in and vote the tiebreaker. So they could pass the laws. And Biden's plan just needs a simple majority to pass. Okay, so that's how close we're talking about here. But here's the basic summary. If your income is less than $400,000 a year, you won't see any tax increases, and some additional credits may apply to you. They kind of drew that line in the sand at 400,000. Okay, you're wealthy if you make more than 400,000. If your income is greater than 400,000, you may see tax increases. And then the top individual and corporate tax rates will increase. The big one, I think, that's kind of a sleeper is that pass-through entity income will be taxed at higher rates than before. I'll go through that. And pass-through entities are business owners like S corporation business owners, single disregarded entities or partnerships that pass through income on their own personal returns. And then there's going to be a greater focus on tax compliance and closing loopholes, more audits. They're going to make attorneys and accountants more busy, I guess, right? And then removal of tax breaks for oil and gas, additions of tax breaks for renewable energy. So here we go. Provisions made permanent. What they want to do, they want to expand the premium tax credit. That's the one. The premium tax credit is the credit that you get for buying health insurance on the market. Again, those are subject to phase outs, of course. The expanded earned income tax credit, I talked about that for low income earners. expanding child and dependent tax care credits, again, subject to those phase outs. And so excess business loss limitation. So now they've set it permanently where if you're a business owner and you have losses, you can't deduct more of those if you're a single a filer, more than 250. Married filing jointly more than 500,000. Before you could deduct more than that. And then expanding credits for employer provided childcare. So if your employer does provide childcare, they get deductions for that. And so they would get 50% of the first $1 million of expenses that they would provide for their employees. All right, the tax increases. Basically, tax increases would only apply if you make more than 400,000. The top marginal tax rate they want to move up to wants to be moved up to from 37% to 39.6%. And right now that applies to taxable income on the tax grids. If you're single, $452,700 a year, and married filing jointly $509,300. That's a top tax bracket now, so you'd be bumped up to 39.6 if you fall within that. There's no other ordinary tax change in the legislation. So if you're below those limits, then there's not going to be any changes for you. This is the one that I just know. I work with a lot of business owners, and I know a lot of clients that have S corporations or are partnerships and have these pass-through entities. And so what basically for S corporations, there's a game that we play with the IRS is that you can, it's regarding self-employment taxes. Okay, so let me just kind of summarize this and then I'll kind of give you the example. But there is self-employment taxes usually applies to ordinary income. And so so basically with S corporations, what you can do, there's a tax advantage where the owners can pay themselves a salary, okay, and that's would be subject, and that's a W-2 income, and you're subject to self-employment tax on that. Self-employment tax includes Social Security, FICA, and Medicare tax, and that's a total of 16.2% between the two of them. And so basically what would happen is they would say yes, and Social Security, that Social Security tax goes away once you make more than 142,000 of your wage income. You're not taxed anymore on that 12.4% for Social Security, but you're still paying that Medicare tax of about 3.8%. So this plan says, you know what? We're tired of that game that you're playing. So what the S corporation people would do is pay themselves a salary that would be that the IRS would recognize as okay to pay, and pay the self-employment tax on that. And then they would just dividend or distribute profits to themselves at the end of the year or during the year, and that would not be subject to the self-employment tax. This says, no, you make it more than $400,000 a year, you're paying basically the tax hike for you of 3.8%, that you would avoid that Medicare tax. You're going to pay that now. Okay, and I think that's going to impact a lot of people, because I know a lot of business owners that are S corporations. You're basically getting a 4% tax increase just on that. They snuck that in there. You're always going to pay that net investment income tax. That's the 3.8% as part of that healthcare package. And so that is always there. But that's an interesting one to me. So I'm watching that one closely. For hedge funds, tax compliance and carried interest. So they wanted to focus on hedge funds, thinking that they made too much money, and the people making that are in the hedge funds, so they could play games and treat the gains that they make within the hedge fund as capital gains. This legislation is saying, hey, if you're in the hedge fund and you are an active player in the hedge fund, this is ordinary income to you. It is not going to be. We're not going to let you get away with long-term capital gain treatment. And long-term capital gain treatment, which is a big one, another big proposal that's out there, which I'll get into, they're favorable. Okay, long-term capital gains are when you pay, if you hold like a stock or an investment for greater than a year, you can either pay 0 capital gains if you're in a lower tax bracket, 15% or 20%. Okay, and so those are a lot different than the 39.6% that they're talking about. So they want to get rid of that. And then more reporting. Okay, you're going to get more reporting. So, it's going to be more record keeping for everybody. New information returns from any financial institution with an account inflow or outflow or balance of $600 in a year. So you got anything with $600 in a year in it, they're going to want to see everything. And that includes cryptocurrency for those of you who are in the cryptocurrency market. The American Jobs Plan. Okay, so this is on the corporate side. American Jobs Plan corporate tax rates, that was reduced down to 21%. They want to move it back up to 28% for a corporate tax rate. The GLTI is international taxes. So for those of you in the international world, there's the update for that. And if you're part of a big conglomerate, there's a 15% minimum tax on book income of corporations with 2 billion of net income or more. Those numbers can get big. I would multiply 2 billion by 15%. That's a big tax for them. Multinational businesses, deductions. So this is the whole point of this one, is keep the businesses and jobs on shore. Just deductions disallowed for expenses in conjunction with offshoring a U.S. trade or business. New credit for 10% of expenses in conjunction with onshoring U.S. trade or businesses. Okay, that's pretty clear how that is going to go. And then, and again, foreign tax updates as well. I just threw that in there for those. Energy tax issues. So a lot of the fossil fuel tax breaks, those are gone. New tax credits on other renewable energy tax breaks instituted. There's just too many for me to list them all. Other tax credits, these are all geared towards low income areas, areas that they feel need development, low income housing areas, new markets tax credit, low income housing tax credits, new tax credits for improving housing in distressed neighborhoods. So there you go. That's the focus. What didn't make the cut? Okay, so this is not in the plan. That kind of I was interested in saying that didn't make it. Limitations. So a lot of itemized deductions get phased out, but there were some more limitations that people thought would be put in there. Those were not, and for a high income taxpayer. Wages over $400,000 becoming subject to Social Security tax. So remember, I told you before, once you're at 142,000 of wage income, you don't pay any more Social Security tax. They said, well, one of the thoughts was, once you make it over 400, we're going to put that back on you, but that didn't make it. From the estate, now we're going to talk a little bit about estate laws, right? So the estate tax side of things, for those of you who are my clients, how I always say your coupon, your federal estate tax coupon, everyone currently has a coupon worth $11.7 million. And that was passed through a budget reconciliation, which this would pass through a budget reconciliation as well if these laws got passed. And what a budget reconciliation is, it's not a permanent tax cut. It has to sunset in 10 years. And so the estate exemption, the coupons that are now as high as they've ever been, they are sunsetting on their own January 1 of 2026. They're going back down to $5 million per person. And so I'm thinking maybe they're just thinking, hey, it's going to go down on its own. It didn't make the cut for this one. So if it does pop its head up, I'll let you know, let our clients know about that. But right now, the same estate tax exemption level is on track for 2022. Deductions for 401k contributions. So they wanted to replace the deduction that you get for contributing to a traditional 401k with a credit. That didn't get through. Qualified business income deduction. We thought that would be phased out for high income taxpayers. These are people with also pass-through entities would be in tune with those QBIs. And then any new credits for low income renters, that didn't make the cut either. So those were interesting to me. All right, so this part of it focuses on the kind of the estate planning tax changes, but there is an income tax component. I think this is one of the biggest ones that most people are worried about, at least from my side that I'm seeing. And so basically the one that's getting the most attention is a long-term capital gains rate, right? I alluded to this earlier. And so the long-term capital gains rate is favorable right now. The proposal is that if you make $1 million in a year, then those rules don't apply to you. You're going to get taxed at ordinary income. It's going to be a 39.6% federal tax. And so, on its face, it seems like, well, if you're making $1 million a year, that makes sense. But I've got a lot of clients that own real estate, and they're not making $1 million a year, but they may make $1 million when they sell their big piece of property that they've been holding. This applies to that, okay? And so be careful. I mean, that's just one scenario. Or you sell your business, right? It's not something you're making it every year. Hopefully you are, that's great. But this is more of a, anytime you're making that $1 million a year, that capital gains rate is gone for you. That's on the proposal. So this is kind of like playing it out in Virginia. If you had made adjusted gross, if you had more than $1 million in a year, you sold your properties, and basically you would be taxed at 39.6% at the highest tax bracket for that. You always have that net investment income tax of 3.8% for the high income payers. So that's 43.4%. And then you've got Virginia tax on it. If you're in Virginia, just plug in whatever your state tax rate is from whatever state that you're at. So you're basically 50%. Okay, so that's a big deal, and that can really affect a lot of people. They are saying that it could be even retroactive to assets sold after April 28th of 2021. That would be a big deal, right? So you sell it even this year, and so that's something we're keeping an eye on. Keep it on that one. So how does that work with the estate planning world? Okay, and this is a big, I'm an estate planning attorney, so you really need to, this is for me, I want my clients to understand this, because the estate tax doesn't apply to a lot of people right now, right? If you're making if you have more than $11.7 million, those are higher net worth estates and married couples. Without doing any advanced planning, I'm sheltering $23.4 million. Okay, even if the estate tax coupon goes down to $5 million per person, that still doesn't affect a lot of people. Okay, but this is going to start affecting people. It's going to replace the estate tax. So I think it's very clever. I don't know. We don't think this one's going to get through, but this is a big deal on this. Is basically it's going to affect people that have more than $2,500,000 worth of assets. Okay, and this is something that just they don't realize. A lot of people don't appreciate it. And so this is how it works. And so basically, right now, when you die, let's say you own a Tesla stock, right? And let's say you bought it at $300, and when you and if you sold it for $700, you pay a capital gain on the difference, right? Great. But if you die, one of the benefits in the IRS tax code is that if you own that stock at your death, right? It's not in a retirement plan; it's just that you own that stock, and it's at $700 when you die with it. It gets a step up in basis, which means it's the people that inherit that stock now reset the cost basis to $700 for them, and then they could sell it the next day with zero capital gain, okay, at $700 if they had that. What they want to do now is they want to say, you know what, forget that step up in basis stuff. We're losing a lot of tax money on that. We're going to say when you die, it's as if you sold everything at your death. Okay, and we're going to add up all your assets at death, and that is what you gained at your death, and you got to subtract that from what you bought those stocks for, and that's a capital gain tax that your estate has got to pay. Okay, and there's some coupon. They give you a coupon. They say you get a $1 million coupon per person, right? So you can exclude the first $1 million of gain, and if you're married, you can exclude $2 million. So that's a big deal to me. Or at least that's what I said in my world, right? Because that is something that's out there. I'll talk about this grantor trust rules after that, but I wanted to show you this other slide. So $1 million per person lifetime exclusion, and then so you get $2 million per couple, and then you get an exemption if you die with a primary residence. So if you're single, so you get if your house is part of your estate, right? $250 for singles and $500. So effectively, if you're a married couple, the first $2,500,000 of your assets, they're covered under this proposal. You got $3 million, then you've got a $500,000 gain, and then the CPAs and attorneys got to figure out what your cost basis was. So that's what we don't think that one is going to go through, but who knows, right? And so we're going to keep track of what's going on, but that's a big deal, okay? Because that is now taxing people that normally wouldn't have any tax at death. They're saying $2,500,000 is the line, okay, not 10. That's why they don't want to touch the coupon. They're like, we don't care. We're going to change this law, and so that doesn't really matter. So that's a big deal. We'll keep track of that one, and so that's important to understand. This is another one that's important. Places like-kind exchanges. So I work with a lot of people who are in the real estate world, right? And there's something called a 1031 like-kind exchange when you're dealing with real estate. If you have investment property and you you buy, you rent it, and then you sell investment property, there is a technique under the IRS tax code, it's authorized by statute, that you can defer the gain on that sale of that investment property if you reinvest it into another investment property, okay, within certain time guide. They're saying, nah, we're going to put a cap on that. $500,000, we're going to cap the gain that you can defer in any year at $500 for single people and $1 million for married couples. Anything over that, you're going to be subject to tax, even if you didn't get any money and you plowed it back into another property. That's another big deal, right? A lot of the real estate owners there watching that one closely as well. All right, so planning applications, basically, from my side of the equation, what I'm, looking at is what can you do as far as from the estate planning side and the like. You just need this. These are some of the common techniques that we're using. These are advanced planning techniques typically, but they may make sense now for people who are at more than 2,500,000 of estate if they get that cap, that step up, if they eliminate that step up in basis, right? Which again, we don't think it's going to go through. We'll know more around Labor Day, but these are basically trusts that you can create now and grandfather yourselves in. Okay, the lingo. There's something called a spousal lifetime access trust, a grantor deemed owned trust. Some people call them GDOTs, where like attorneys love acronyms. The spousal lifetime access trust is called a SLAT. The grantor deemed owner trust, GDOT, and then the grantor retained annuity trust is the GRAT. Okay, and this is where, if you've got assets that are appreciating and then you're subject to these estate tax techniques, you can freeze your estate or make gifts on a leverage basis to the family members. The concept is what's important, okay? Don't worry about all the names. There's a lot of different names that are out there. I always find it's easier to just explain it with an illustration. So now I'm going to talk about, just zero in on just estate taxes, not talk about the income taxes right now. And so this diagram is typical kind of, I have a story my clients know. If you're not familiar with that, I call it my IRS supermarket story. So I'll tell it real quick to refresh everyone's memory if you haven't heard it, because we're talking about estate taxes. I gotta tell you my story. So in the IRS supermarket story, let's say we have a married couple situation and everything in the supermarket is subject to death tax, okay? And we have a husband shopping cart and a wife shopping cart, for example. And then let's say this is a checkout counter, also known as an IRS auditor, right? When you die, they want to know how much you die with. All these laws are saying, what did they die with at death? What's the value of it, right? And then that side over there, let's say it's a parking lot. Parking lot is death tax-free zone. The goal is to get as many assets from the supermarket out to the parking lot so we don't pay any tax on that. I always have my husband's check out first in my plans. You can do whatever you want in your plans, just statistics, right? So husband checks out first, and let's just say for argument's sake that we have, that the husband has 11.7 million in his bucket, okay? Just using that example. At his death, there's two options he can do. First option is he can use his coupon. Everyone has a coupon on the federal level worth $11.7 million, okay? You can give that coupon to the IRS person, they scan it, you bag up the assets, you take all of it out, you didn't pay any tax on that money, that's option one. Option two, you could say, I don't want to use my coupon, leave everything on the belt, leave it to my spouse, let her, when she checks out, she can deal with it at that point. You didn't pay any tax on the first death because you didn't get anything out, but you better believe that they're waiting for the surviving spouse, okay? Under the current laws, you can have $100 million and leave everything to your spouse and not pay one dime of tax. But you better believe that they're watching the surviving spouse. And when the surviving spouse checks out, then let's say that they have 11 million bucks of their own. So we're talking $22 million estate, large size estate. And so let's say that their coupon level at that amount is 11.7. That goes out tax-free to the parking lot. The remaining assets of say 11 million bucks, that gets taxed currently at 40%. That's due 9 months of the date of death. That's for the kids to pay, okay, or the beneficiaries to pay. So what's the point about an IRS supermarket story is that get double coupon days, right? It's take advantage of it, and you should be good unless you're over like 23 million. So, and that coupon is what I've been talking to you about, is what's part of that, was part of that reconciliation, which is going to be sunset, which is going to sunset January 1 of 2026 to 5 million. So you just change the coupons, right? So then I can shelter 10 million for my client's taxable estate. So this chart just basically shows, this is Mike Smith's Rev Trust revocable trust, okay? This is Susan Smith's revocable trust. Husband checks out first. Basically, we have him. Usually, most people who have revocable trust-based planning, most of our clients, we build in the coupon to your trust. When you die, we're going to take the first 11.7 million out. My clients call it either the coupon trust, right, or the family trust. Attorneys will call it different things: B trust, credit shelter trust, bypass. It's the same thing. The 11.7 million goes there. And then if they had more than 11.7 million, we'd leave it in the supermarket, leave it to the spouse, so there would be no tax, and what's called a marital trust. And when the surviving spouse checks out, they add up what's in her bucket, and then whatever, if there is anything in this bucket, and then anything over the coupon gets hit with a 40% tax. That's a basic plan that's out there, and most people have tax planning built into their revocable trust-based planning. So what this spousal lifetime access trust is, it's a way to lock in your coupon now and move stuff out of your estate now, and all that appreciation will grow outside of your taxable estate. It's not subject to any of these new rules that they want to pass with regard to it, because you're grandfathered in. And the way that you do it, we just use we use the tax code. We say, okay, instead of waiting till death for Mike to use his coupon, we think that there's appreciating assets, and I don't know if I can get my little cursor on this. Can't keep getting. There we go. We're going to use his coupon during his lifetime, and this is what's called a SLAT, Spousal Lifetime Access Trust. Same thing as the family trust at death. In this situation, it's for the spouse's benefit. The spouse is the trustee. The spouse is the beneficiary. We're just playing this IRS game. But once that money is out there, all appreciation going forward is outside of your taxable estate. Now, you're always going to pay income taxes on that money, okay? You can't get around that. But this is going to avoid all those estate tax issues that are out there. So here's an example of, let's say Mike is a government contractor, or they have a government contracting business. They could, and let's say their estate is at 14 million. This is a larger estate. But if they pass those other rules, then maybe those numbers go down, right? But I'm just saying, hey, you got a $14 million estate. Under the current laws, you've got a 23,400,000 coupon between the two of you. You haven't used any of your coupon yet, so you guys are good. There is no tax due. Your 14 million is less than 23.4 million. You're good. On the sunset side, I think I used it should have been Mike and Susan here. Sorry. I don't want to confuse people with my fictitious people. Okay, so the if it's when it sunsets at 10 million. Now, of course, on the sunset, there is some what they call indexing provisions that it may be a little bit more than the 10 million, but just let's go with the flat 10 million. So 5 million each per person. If you had a $14 million estate, guess what? You're at 4 million over. But the new tax laws, the sunset tax laws, or that they want to propose, is 45% would be over that. So you'd be paying, beneficiaries would be paying a 1.8 million. But if you do the SLAT and move those things out, basically you're not going to be paying any estate tax on that and avoiding that capital gains debacle that's out there. So good strategy, definitely for larger estates. This is a good strategy for those that think they're going to be over 10 million at some point. We know that's kind of a good conservative approach to it, because we think it's going to go down to 10 million. May not, but that's kind of the prediction that's out there. So the only question now is, if you're below 10 million, if you're between that 2.5 million and 10 million, do you need to be doing this advanced planning? I hope not. But and I mean that sincerely, because this game is kind of ridiculous. Okay, and these are advanced planning techniques. And so, and then also I just threw in, like, if your estate grows, right? Even if you have if you have a $10 million estate now and you're younger, or you've got investment, if it's going to grow, right? And it's all growing in your estate, it just exacerbates the problem, right? These are estate tax numbers. Can you imagine if we had to deal with that capital gains tax and we just, you sold 30 million at that? So these are larger estates. With the spousal lifetime access trust, none of that appreciation is in your estate. It's truly what we call an estate freeze technique. Okay, so that's the basic idea to the spousal lifetime access trust. And a grant or deemed own trust is the same thing, but it's just that where the spouse is not a beneficiary. So a lot of people think that if they move stuff out of their taxable estate, they don't have access to it. Basically, the pros are you lock in your current exemption, you're grandfathered against those realization events. It removes the future appreciation from your estate, but the assets also can be accessed by the spouse. So if you move stuff out, yeah, you can't directly get access to it, all right, but you can have indirect access to your spouse on these, and that's the deal that you have to play. It also provides really good asset protection for those clients that are concerned about asset protection. A big myth that I keep trying to dispel with people when they think about trust, things seem to happen with people, but a revocable living trust does not provide you, your own revocable trust does not provide you with any asset protection, because you can change it, you can do whatever you want, you can move stuff in and out. It's a great way to centralize management of your assets, okay? And then after you pass, you can say, this is my hard-earned wealth for my beneficiaries, but not for my beneficiaries' creditors, right? Not for my beneficiaries' spouses, or not for Medicaid to make me spend down, make my family spend down. That's trust law, that's basic trust law where you can do that and build that into your plan. And most of my clients have taken advantage of that. But if you're talking about, no, I'm putting this on my revocable trust and now you can't sue me, that's not how that works, okay? But with the spousal lifetime access trust, you do get asset protection because that is an irrevocable trust. The spouse is the trustee and beneficiary. And even if the spouse got sued, it's structured in a way where, hey, they're not allowed to use it for the creditors. Okay, so that does provide good asset protection. The con, so you can also, the pro also of the, and I'll make it bigger. The pro also of the spousal lifetime access trust is that you can have access to the trust assets, right? Through like you put your investment account out there. You can get access to it through the spouse, make distributions. You have rental income coming through there. If you have life insurance policies that have cash value, if you have a permanent policy that has cash value, you can access that through the spouse as well and take loans against the policy if you want to do that as well. And life insurance, go figure, the life insurance lobby is very strong. Life insurance is one of the planning techniques that are out there, right? Because life insurance comes in income tax free. And so all those capital gains, realization events, all that doesn't apply to life insurance because it's coming in income tax free. So those are things, if it's, those are things, but it has to be suitable and you got to talk to your advisors about that. But that's something that that works in this type of environment. It can hold any of your business interests, these types of trusts. And right now, they still haven't, you get grandfathered in on these, what's called grantor trust rules, which we move them out of your taxable estate and they're out for estate tax purposes. But from an income tax perspective, it's as if you own it. You're still paying your income taxes like you always do. So there's not going to be any change. Whatever income taxes they're out there, that's what it's going to be. The cons on these type of spousal lifetime access trust and the GDOTs are when you can't have your cake and eat it too. So if you move it out of your taxable estate and it's not valued at your death at the checkout counter, then your beneficiaries don't get the step up in basis that we were talking about at death, right? So do I want to avoid estate tax or do I want to have a step up in basis and have a lower income tax? And so for most clients that don't have larger estates, it makes sense to keep those assets in your estate, let the kids get the step up in basis. But if they get rid of the step up in basis, this is not an issue anymore. Okay, so we can move it out and it's not going to be a problem because you don't get the step up anyway. All right, and you can maybe save on those capital gains taxes that are out there. The other con is the grantor does not have direct access to the assets. So you have access as discussed through the spouse beneficiary in that situation. And it could be anybody, right? But usually married couple situation, that seems to be one that works most of the time. Flexibility can be built into the trust to account for changes in the future. So people hear the word irrevocable. we can build in flexibility. Okay, so to adapt for changes in the laws and kind of move things around if necessary. And then also, you can, if the spouse, if you want to just unwind it completely, since the spouse is a beneficiary, assets can be distributed out if to the trust to the spouse if necessary. So you can just, okay, let's distribute it out. The other type of trust that's out there is a GRAT, a grantor retained annuity trust. And this is basically a trust, a way to make a gift out of your taxable estate to your beneficiaries without using much of your coupon, okay? And so this is for people that don't want to use up much of their coupon or don't have much coupon, or their assets are too much, they're over the coupons. And basically the rule is this: there's something called this IRS 75/20 rate. This is this fictional interest rate that they say you can, as long as you make this much, you put this much money, you put $1 million in this trust, you get, the way this grantor retained annuity trust works is that you can put $1 million in, you got to pay yourself back the $1 million over a time period that you can select, plus an interest rate, okay? If it's really low right now, 1.2%. And so the idea, right, is that, okay, what do we have as highly appreciating assets? Or if I'm going to have a business liquidity event, I'm going to have a sale of a business that might go up 25, 30%, where I can get back, you know, I'm putting money in and it's going to go up a little bit, but any appreciation over and above it is basically a tax-free gift to my beneficiaries. That's the basic concept before it. These are very effective techniques. They're authorized by Treasury regulations and statute. They're safe techniques. And so these are for people who are conservative on the estate planning side. I think the easiest way is just showing you the numbers. If you have $1 million and let's say there's 25% growth, so highly appreciating or has a lot of income producing assets in there. So basically this is showing, okay, the $1 million is coming back to you, but $250,000 gross, there's a payment back to you, and there's a remainder. This remainder on this is a 2-year GRAT they call. So $1 million goes in, you get payment back, and then the second year you get a payment back to you, and then what's left after you get your payment back plus the 1.2% is $438,000 because it grew a lot. That's all of basically a gift to the beneficiaries for nothing, basically. I said 400 to $1 gift to get all that out. So that's a good strategy to know. I just like Gary Larson. I just like these different techniques. If we pull this off, we'll eat like kings, right? So I love this one. And if you have for my business owner, so a lot of business owners are worried about, okay, what if they do actually pass this capital gains rate deal, right? If I make $1 million when I sell my business. So some people are thinking about selling their business before this happens. It's kind of interesting how this April 28th number is out there, right? And that if you do it, you may be taking a risk now, or no, it starts next year, they might say, January 1 of next year. But this kind of works in conjunction with that. If you want to sell your business and also get leverage of getting that asset out to your beneficiaries, if that aligns with your goals, this is kind of showing you that example. So that, let's say you have a business that's worth a net asset value of $10 million, but only a fair market value of 7 million. How does that work? Well, you can build in what's called discounts to your business if the operating agreement or the shareholders agreement are drafted properly and the like, where, hey, you can't sell this business on the market for 10 million because they have all these restrictions. And so we kind of depress the value of the stock. So the way we do it, let's say there's the business could be sold for 20 million. It could be a potential deal in 2 years. Well, what you do is you create a 2-year GRAT, and you put the stock in there, and that's $7 million. So $7 million is going to come back to you, plus that little 1.2% rate, right? Anything over that is all outside of your taxable estate. That 12.87 million. So I don't want to get into all the weeds of this, but basically I'm hoping I'm conveying to you that those are just techniques that are out there that may be available. GRATs are very simple. They're safe, they're effective, they're flexible. A lot of people do them. We do a lot of GRATs. There's no additional income tax returns that are necessary for those. The payment of the annuity is not a taxable event. and the client can serve as the trustee of it if they want to. But in the closely held business side of things, you don't want to be the trustee of it. That's that one exception. Yeah, this is just more telling you that these are authorized by the code and the like. So that's just reinforcing what I'm telling you before. So there's another Gary Larson. I'm not sure, you don't carry any other styles. And so the point of this one is, there's not a one size fits all with the planning techniques. And if you have, good advisors, it just depends on your specific situation, what they're doing out there. The goal today was just to kind of show you, this is the law, this is what's out there, this is what's going to be, and this is what we're talking about in the estate planning community. So hopefully you've got that. Some of the big issues that are out there is that step up in basis, that $1 million rule that's out there, and then some of the other things that we were thinking about is that a lot of people are maybe doing some income tax planning now. Okay. And so what are ways to reduce income taxes in the future? Things like Roth conversions, a Roth IRA. So if you don't know about that, talk to that about your advisors. They are individual retirement accounts that don't get taxed when you take the money out, right? Traditional IRAs, you put the money in, it grows tax deferred. When you take it out, Uncle Sam's there with you, right? It comes out as ordinary income taxes. And as the tax rates rise, a bigger and bigger chunk of your IRA. And that's also your 401k works the same way, right? Your 401k, when you retire, typically you roll it into an IRA, and this is how the rules work, right? So the idea would be, does it make sense for me to convert some of my existing IRA over to a Roth IRA? The deal with the IRS devil there is you pay the tax now rather than later. So some people are saying, well, tax rates are probably lower now than later. Let me take the tax hit now and then convert it, and then tax-free income later. But there's, that's an analysis that you got to go with your tax advisor to see that makes sense. I'm just telling you, this is what's out there with regard to it. Another thing that I find that most people aren't aware of is that ask your employers if they offer a Roth 401k option, okay? The way a traditional 401k works is that, let's say you make $100,000 worth of income, and let's say you contribute the maximum that you can. Currently, you can contribute $19,500 to your 401k if you're under 50. You can add another $6,000 or $7,000 to that if you're over 50. And so basically, if you make $100,000, you contribute $19,500 to your 401k. It reduces your income from 100 to 80, about 80,000. And then you're putting this money in this retirement account that's growing tax deferred. But when you take it out, it comes out as ordinary income. Okay. The Roth 401ks is saying you don't get that deduction up front. It all goes tax deferred, but it comes tax free. And as people get higher up in incomes, the tax deduction that you're getting is not really as valuable, or you have to look long-sighted, right? Don't look short-sighted. What's the better play to make over the long run? Okay, with regard to that. Let me see. I got a question. Okay, yeah, I got I got a quote on the Far Side fan. Yes, I am a Far Side fan. So basically, the point of it is, talk to your advisors. If I'm saying actually, resonates and makes sense, give us a call for the legal stuff. But the point is, again, a lot of stuff is happening out there. The themes. I think one good. I saw an article. This kind of gets you on the estate planning side. It wasn't even an article. This is on this is the White House government briefing room fact sheet, right? So this is kind of giving you the theme of it. I'm not making any political statements. It's just helping you understand where these thoughts are coming, or the intent behind it. All right, let me just pull it up here so you all can see it. The president's tax reform will end one of the most unfair aspects of our tax system, that the tax rate the wealthy pay on capital gains and dividends is less than the rate that many middle-class families pay on their wages. Households making over 1 million, the top 0.3% of all households, will pay the same 39.6% rate on all of their income, equalizing the rate paid on investment returns and wages. Moreover, the president will eliminate the loophole that allows the wealthiest Americans to entirely escape on their tax on their wealth by passing it down to their heirs. Today, our tax laws allows these accumulated gains to be passed down across generations untaxed, exacerbating inequality. The president's plan will close this loophole, ending the process of stepping up the basis. That's what I was talking about, okay? For gains in excess of $1 million, 2.5 million per couple when combined with the real estate exemption. All right, and making sure those gains are taxed if the property is not donated to charity. The reform will be designed with protection so that family-owned businesses and farmers will not have to pay taxes when given to heirs who continue to run the business. So there may be some ways to get around that if you have a family business. So, you know, whatever your political philosophy is, that's where it's at right now. And so I'm concluding, did it under an hour. All right, let's see if there's any questions or anything on the chat. Be happy to answer, try to address those. But basically, just stay on top of laws, communicate with your trusted advisors. We'll probably do another one of these closer to the Labor Day when things start getting a little bit more clear. If you are interested, just let us know. Just shoot Michelle an email. We'll make sure you're on the list. We'll send it out again. For me, very, you know, interesting times, a lot of stuff going on here. I gotta make sure we're on top of it. Very good. I will basically hold on for about a minute or so, and then we will conclude. Very good, everybody. Hang in there. Thought we had it. I thought we had it nicked, and now we got this variant out there. So, you know, we'll see how things play out. All we know is we just adjust. Let me see what we got. Oh, there's a good question. So I had one client say, what happens if you transfer your assets into a SLAT and your spouse passes on before you do? That's good. I should have addressed that. Common concern. So we can structure the plan in a couple different ways, where if the spouse predeceases you, that the assets could actually be pointed back over to the surviving spouse, okay, in a trust for their benefit. So don't think that we didn't think about that stuff. So yeah, and we can, I'd be happy to go into detail, but that is a concern that can be avoided with proper planning. Great question. Very good. I think I am going to, oh, I've got, okay, there's one question that came in that's pretty specific regarding a 49% shareholder of a closely held corporation. So if you want to, that one is specific. If you want to just reach out to Michelle, we can give a talk. We'll schedule a phone appointment. Be happy to discuss that. Probably more than we would go into today, but definitely you've got options. And so we'll go ahead. We can address it. Very good. All right, everyone. I'm going to end it. Have a great weekend.